Hey guys, welcome to this YouTube channel once again. In this video, we are going to be looking at the order block trading concept that you possibly do not know about. So guys, you would do well not to skip any parts of this video so that you will be able to comprehend the concept for better implementation as you wish. So guys, let's head to the charts to look at this order block trading concept. So a lot of traders have been wondering why price at times react at certain levels without actually reaching their point of interest. So that gets them confused and then they end up losing certain trade entries. So we're going to look at this concept on how to utilize the single candlestick order block in order to take entry from such price occurrences. Now you can see here we actually have a bullish market condition here. You can see price push to the upside. We have the first pullback, price push further to the upside, and then we have this swing low as our inducement zone. We can see we have our valid high point because price pushed to the downside and took out this inducement zone. Now you can see price further push to the upside, and then we have a break in market structure. Yeah, this is a valid, strong low points that created a new higher high point. This is a higher high point because you can see price returning to the downside and then price raided the inducements. Just as I've said earlier in other videos that price move towards grab liquidity, fill up inefficiency. So that is what price actually moved to fulfill. So you can see in this particular condition where we can have price just sweep the inducements without reaching our decisional point of interest or our extreme points of interest. The decisional point of interest is actually the point of interest that is actually below the inducement swing low or above the inducement swing low, depending on the market's condition. You can see in a bullish market condition, we have the inducements above the decisional point of interest. So the decisional point of interest is actually the point of interest slightly below the inducement, while the extreme point of interest is actually the point of interest that is also below the decisional point of interest. So the decisional point of interest is actually a 50-50 chances trade zone level. It's not really strong, but also it's a level where you can also consider to take entry. That is why it is called decisional. You make the decision to either execute a trade at that level, possibly by waiting for price to return into that zone, and then you interpret the price action in a lower time frame to take your entry. But with the extreme point of interest, you can possibly set a pending order because you actually have a high probability chance of price actually strongly reacting at that point of interest and then going in your intended analyzed direction. So let's look at price here. You can see that we have price push to the upside, and then we have swing low as our inducement, price return and greater the inducement level. So what you're going to see here is actually this. You can see price took out the inducement, the swing low, and you can also see that price took out the previous candle low. So in actually validating our order block based on the criteria necessary, we said that it must take out liquidity. Take out the low of the previous candlestick or take out the previous swing low points. So you can also see that here we have price took out this inducement level. This candles week took out the inducement level, and also this candles week took out the previous candle week low. So you can now see that here we have an order block created because you can see that this is the last selling move before the buy move to the upside. What you would see in this condition is that price did not return into the decisional point of interest. We have a sweep of the inducements and then a sweep of the previous candle low, and then you can see price created a bullish candle to the upside and then took out the high of the last sell move before this buy move to the upside. So you can see we actually have a valid order block here because you can see that this candle swept the low of this previous candle and also took out the inducements. So you can see now price created this bullish candle to the upside. This bullish candle closed above the weak high of this bearish candle. So you can see we have a valid order block. So instead of waiting for price to push to the upside to rate this high before you expect a pullback and then take an entry, now you can switch to the lower time frame. What you are expecting is the return of price to come mitigate the order block, fill up the inefficiency resting here, and then you see price push to the upside. So you can see in this condition here, price did not pull down to the decisional point of interest. Price only swept the inducements, meaning if this was your point of interest, you can see price did not return into your point of interest. Price was took off after sweeping the inducements. So how do you take entry in such cases? Then this is where you now have to look out for the single order block candlestick pattern in order to actually take your entry. So basically, this is trading based on the order block candlestick, not basically based on structure in a higher time frame, but based on the candlestick formation, then which can be interpreted in the lower time frame. And then you have what structure in the lower time frame to execute your entry. So you can see what you're expecting is a return of price to come mitigate the order block. So when you drop to the lower time frame, this is what you're expecting to see. You want to see price push to the downside. You want to see price pull back. This is now the zone. This is now the low of this candle created here. This is the structure in a lower time frame. But in the higher time frame, you're just going to see a candle formation. And then you see that this candle push to the upside has swept this high of this previous candle is what created this chalk. Give us a change in character. Because you can see this candle broke this weak high. So on the lower time frame, you're going to see a structure formation. So what you want to wait for is to see in the lower time frame that price create the inducement swing low, price push, and then rate the high. So what you're expecting is now to see a return to the lower time frame point of interest for price to mitigate the lower time frame point of interest, rate the inducement, and then you move with price to the upside. So this is the case where you would see price just rate the inducement without really returning into the decisional point of interest or possibly to your extreme point of interest. So what you need to look out for when you see now price reacting and pushing to the upside, you want to spot out the single candle order block and then switch to a lower time frame and then look out for structure to take your entry. So in the case now where you have price pulling to the downside, the same thing applicable to this particular price interpretation is also applicable to when you see price returning to the decisional point of interest, where you see price doesn't really sweep the inducements and then raid the liquidity of the previous candle low, whereby you see price just push further down to the decisional point of interest. So what you want to see in order to execute trade from the decisional point of interest zone is actually to see that now price takes out the previous low of this candle, price sweeps the liquidity, and then you see this candle close above the high of this candle that swept the low of the previous candle resting here. So you want to see price sweeps this high, and then you can see that now you have a valid single candlestick order block resting here. So the same thing we actually treated here is the same thing that you would also consider here when you drop to a lower time frame. Because what you would see now, you can see price left the inefficiency here. You have your price imbalance here. So you're expecting to see the return of price to fill up the inefficiency, mitigate the order block, and then you see price push to the upside. So when you come to the lower time frame, you want to see price create the chalk, the change in market character, create the inducement, and then you see price return, rate the inducements, mitigate the lower time frame point of interest, and then price push to the upside. The same thing applicable when price return to the extreme point of interest. In the case whereby price just further push to the downside, doesn't respect the decisional point of interest, and then you see price reacting at the extreme point of interest. What you want to see in the candle formation is that the last selling candle rates the low of the previous candle without a candle body closing below the weak low of the previous candle. So then you see price creates a bullish candle to the upside that rates the high of this candle. So you want to consider this single candlestick order block when you are looking at your decisional point of interest and also the rate of liquidity, the rate of inducements. You don't trade the single candlestick order block randomly, and you must trade them in the direction of the trend. So you would see that now we actually have our order block resting here. So we want to see price return to mitigate the order block and then further push up price to the upside. So you also interpret this in the lower time frame, and then you can find entry when price is returning to the lower time frame point of interest. Then you take your entry at the lower time frame POI, and then you go long in that particular asset class. So this is how you want to consider the single candlestick order block. So I'm going to show you guys another example on how to consider the single candlestick order block, how to interpret that in a lower time frame for you to actually have high probability trade setup and execution. Hey guys, if you're gaining value from this particular video and you're new to this YouTube channel, please kindly subscribe to this YouTube channel to be part of this community. And also please like this video, comment in the comment section what you possibly do not understand. And then I would come with a next video to actually address that, to explain that properly. And also, if you have certain challenges in price analysis, also comment in the comment section. And then I would also make a video to address your particular challenge. So let's head to the charts to look at the other example. So let's look at this example also. You can see in the previous example, we have price waiting for price to create a bullish candle to the upside to rate the high of this candle that sweeps the low of the previous candle. But you can see in this condition, we do not have a bullish candle created to sweep the high of the previous candle. Now you can see we have our bullish market condition here. Now you can see we have our inducement. This is our valid high points because price already have rated the inducement. So in this condition where you see price actually takes out the inducement, and then price takes out the low of the previous candle, this candle body did not close below the inducements. What price did was to grab the liquidity, and then we see price close above the swing low, which is actually our inducement low points, and then the what's previous candle low points, price closed above it. So what we are going to be considering is we can consider the wick of this candle as our point of interest. So we can mark out this wick as our point of interest. So this is in the condition where we do not wait for price to create a bullish candle to the upside that sweeps the high of this candle. This is actually a risky trade setup. But if you understand what you're looking for in the market, then you can possibly execute using this single candlestick order block also. So we can consider the wick of this candlestick, or we consider the entire candlestick as our point of interest. So we consider what's the wick of the candlestick as our point of interest, or we consider the entire candlestick as our point of interest. So because what you're seeing is not that price broke the inducement level. Price just grabbed the liquidity resting here, raided the inducement, took out the swing low of this previous candle. So you can see price closed above the swing low of our inducement and also above the wick low of this candlestick. So what you are expecting is the return of price to come mitigate the wick of this candle and then price push to the upside. So you see, this is actually a risky trade setup. Now in the lower time frame, what you're going to see is that you see price push to the downside. You see this push to the upside because we do not have bullish candle created sweeps the high of this candle. That is why you would see that we do not have a change in market character here. So what you need to do in the lower time frame is to look for the order block in the lower time frame within this higher time frame candle, and then expect that price come mitigate the order block and then price push to the upside. Or you can have the condition where price return into your POI, your decisional point of interest. You can see the candle rate this low point here. And then you would see that you have a bullish candle to the upside. But then this bullish candle body did not close above the weak high of this particular candle that swept the low of this candlestick. So what you are going to realize is that you're going to have a change in market character when you drop to the lower time frame, because this candle wick in the higher time frame could possibly give you a candle body in the lower time frame. So we're going to have a change in what market's character. So in this condition, you wait for what? Inducement, since you waited for the creation of this bullish candle. That is in the lower time frame. So price return, rate the inducement, mitigate the lower time frame point of interest, and then price pushes to the upside. But in this particular condition here, you do not wait for inducements. You take your entry immediately within the lower time frame order block created, and then price pushes to the upside. So this is another example on the single candlestick order block and how to utilize the single candlestick order block to take your entry. So you can see that what's here, price just raided the inducement, took out the previous candle high, and then you see price close above. You do not have the break of the inducement, which should lead to a change in market character. So you can actually utilize these and then take trade entries that ride with price to the upside. So we're going to now check the last theoretical example before we actually head to the real-time chart example for you to see how to actually utilize this trading concept for high probability trade setup and then high profitability. So guys, in this example, you can see that what we have is actually that what price took out the inducement zone here. So you see we have a change in market character here, because this candle body closed below the low of the inducement zone. But then what you're going to see now, we have the next candle open and then price pushed to the downside, but then we have price pushed to the upside and then closed above the week low of this previous candle. So you can see price closed above the week low of this previous candle. So we have actually the break of the inducements level, and then we have price sweep the previous low of the candle that took out the inducements swing low. So you can see that we do not have really further move of price to the downside. What you're going to see that we have is that the next candle closed above the previous candle's week low. So you can also, in this particular scenario, which is actually also a risky trade setup, you can also consider the week low here as your point of interest, waiting for price to come, mitigate this week low, and then we have price push to the upside. But for a safe entry, you wait for price to create the next candle, and the next candle should close above this week high points. And then what you're expecting is to wait for price to come, mitigate the order block, and then you have price push to the upside. So we also have in this condition where you now have the market actually now pushing further to the downside here. So where you would see that this candle also closed below this candle. So you would see that you do not need to actually take any trade setup here, because you can see price is further pushing to the downside. And then you see price come, mitigates the decisional point of interest. Now in this condition, we can see that price took out this previous candle week low, price reacting at our point of interest. So price took out the previous candle's week low, and then you see price created the bullish candle to the upside that swept the high of this candle. But then what you can see is that price returned and then mitigated the single candlestick order block resting here. So actually we have the transfer of our order block from this candle to this particular candle here. So meaning this is now our newly created order block. So what we are waiting for is to see price, since we have also the inefficiency resting here. So we are expecting to see price return, fill up the inefficiency, mitigate the order block, and then we see price push further to the upside. So also in this condition, what you'll be anticipating in the lower time frame is to see this price action. We have price raid the high points, and then we have price return, create the inducement push, and then we have price come, raid the inducement to mitigate the lower time frame point of interest, and then price pushes to the upside. So that is also in this particular condition where you have the transfer of the single candle order block to this particular bullish candle that left the inefficiency resting here. So this is how you trade from the concept of the single candlestick order block. You also have when price return to the extreme POI, price rate the low of this candle, mitigate the extreme POI, price sweeps this high. In the lower time frame, you're going to see a change in market character. and then you can see price creates inefficiency. We're expecting the return to fill this and then price push further to the upside. So this is what you should be anticipating, expecting when you see price reacting at your point of interest, or when you see price rate the inducement without really pushing further to the downside or upside, depending on the market condition, to actually mitigate your point of interest. I believe this particular theoretical example is helpful to you guys. Please, guys, subscribe to this YouTube channel if you're new to the community, like this video, and make your comments in the comment section. So guys, let's head to the chart to look at the real-time chart example on how to utilize this knowledge for trade execution. All right, guys, now let's look at a real-time chart example on how to execute high probability trade setup using the single candlestick order block. Now you can see from this certain market condition here, you see we have the change in market character here. We have the breaking structure, price took out the inducement, created the high points, and then you can see price pull down and then give us the low points. Now you can see we have our inducement here. We have a decisional point of interest resting here, where you can see price rated through the decisional point of interest and went to the extreme point of interest. And then you can see we have the mitigation of the extreme point of interest. And then you can see price fell to the downside. And then we actually now have a break in market structure at this particular swing low. So price broke structure at this low point. So we can see that we have this pullback here. Let's see if actually price rated the low of this bearish candle. So you can see, let's check that out to validate if that is actually a valid pullback. So we can see this is actually a valid pullback because this is the last sell candle, because the low of this candle rated the low of this candle. And then we have the pullback to the upside that rated this high, rated this high. So we actually have a valid pullback here. So it means that this is now our inducement zone, but then price further push to the downside, and then you see price give us this pullback. So this becomes our inducement zone because this is the last sell candle, but then price pullback and then took out the high. So this is a valid pullback. So we actually have this swing high as our inducement high points. So what we are expecting is we want to see price come read the inducements. So since this is our inducement, it means that this zone here is actually our decisional point of interest. So we can mark that out as our decisional point of interest. So this is actually our 1 hour time frame. So you see we have our decisional point of interest here. So we want to look at our extreme point of interest. So this is actually our extreme point of interest, this particular candlestick here, because this candlestick swept this high point, and then you see sponsored the move to the downside. And then we have a little inefficiency left here. So we see this is now our extreme point of interest, and then we have our decisional point of interest. So meaning we want to see price reaction, either price rate the inducement and fall off, or we see price mitigate the decisional point of interest and fall off, or we see price comes to the extreme point of interest, and then we see price fall to the downside. So let's play price to actually see what we are anticipating and how to actually take our entry from the single candlestick order block. So let's play price. So we can see price is still actually moving to the upside. Now we can see in this particular level, price rated the inducements. But then what you can see is just the way I said that when you want to take entry from a single candle like this without this created ones, it's actually a risky one. Now you can see that we have price took out the inducement level. You can see that price took out the inducement level with this week. But what you would notice is that also that this candle closed above the wick of this previous candle. So it's going to be risky to actually take entry from this particular candlestick. If this candle body actually closed below this wick, then we could consider this wick as our point of interest to actually take entry and then ride price to the downside. Or after the rate of the inducement, we wait for the next candle to be created. If the candle body closes below this wick low, then we actually have a valid reason to take entry from this particular single candlestick order block. So, but for now, we do not have a valid reason, even though price took out the inducements. But what we can now see is that price actually broke through the inducement, because you can see this candlestick body closes above this. So we're anticipating to see the return of price to our decisional points of interest. So let's play price to see. So you can also see that in this condition here, price actually did not close above this week, but you can see the candle body did not close below this candle. So it is still not a valid reason to want to actually take entry here. So let's play price to see. Now price is actually ranging, but now we see price pushing further to the upside. Now let's project this outward to see what actually happened. Now we can now see that what we have here is the mitigation of our decisional point of interest. And what you can see here is that price took out the high of this candlestick here with a wick. We do not have a candle body closing above this candle. So you see, we can now consider this wick as our decisional point of interest, just the way I've theoretically shown you guys from the charts. So you can now see, we can consider this wick as our point of interest, because you can see the candle close below the wick high of this bullish candle. So this wick can be considered as our point of interest. We can decide to take entry at 50% of the wick, and then we see price fall to the downside. Or you can wait for price to create the next candle. If the candle closes below this candle, then you can also switch to the lower time frame to actually spot out how you can take your entry. So now let's drop to the lower time frame to actually refine our entry within this particular single candlestick, considering the wick, or we can also consider the entire candlestick created here. So now let's switch to the 5-minute time frame. So you can see from the 5-minute time frame, this is our entire candlestick here. This is the candlestick from the 1-hour time frame. Now you can see that within the candlestick, where do we have our order block? Let me actually remove this so that you can see clearly. So you see from this low to this high is actually the single candlestick order block from the 1-hour time frame. So what you're going to see here is that we actually have our order block within that candlestick. Within our lower time frame, you see we have the order block resting here. This is actually our ideal order block, this order bearish candle, because that's the last buy candle before the sell move to the downside. So as you can see, it is this bearish candle that pushed price to the upside, rated the high of this candle. So this is our order block. And then you can also see that we have the fair value gap resting here. So you can also see that now for that week, this is the 50% of the week. And you can see the 50% of that week falls in between the fair value gap resting here and also slightly below the order block resting here. So we can take our entry from the order block or from the 50% of the week. Let's switch to the 1-hour time frame to actually look at that properly. So you can see from the 1-hour time frame, let me actually mark out the entire week. So that is the entire week. So you see we have this. So let's switch to the 5-minute time frame. So you can see in the 5-minute time frame, we have the 50% of that week resting within the fair value gap created after the order block in the 5-minute time frame. So let's take our entry from that particular fair value gap in the 5-minute time frame, which is actually also the 50% of the week in the 1-hour time frame. So we're going to take our entry. So I'll set my entry at this particular level, and then my stop loss above the order block, and then I'll be targeting the 1-hour time frame swing low point. So let's switch to the 1-hour time frame. So you see we're going to be targeting the 1-hour swing low point, which is actually this low point here. So let's switch to the 5-minute time frame. So you see, let's switch to the 5-minute time frame. So we've set our entry at the 50% of the 1-hour candlestick week, which is also within the fair value gap in the 5-minute time frame. But we can also set an entry at the order block. But we set it so that we possibly should not lose the entry. So we have our entry here, our stop loss slightly above, and then we have the take profit also to the downside, to the 1 hour low points. So we have our take profits level here. So now you can see we have our 2 entries. So let's play price to see what happens. Okay, so now let's actually see what happens. Let's play price to see. Now you can see price mitigated our 50% of the week. Price did not really mitigate the order block zone. So price filled the inefficiency, price mitigated the inefficiency, and then you can see price dropping to the downside. So let's switch to the 1 hour time frame. So let's play price. Let's keep playing on price to see what happens here. Now you can see price is falling to the downside. So price is still moving. Now we can see price is still moving, yet to our take profits area. Now let's look at something from the 1 hour time frame. Now you would see that now you can see that price took out this level here. So you can see price took out this level here. And then you can also see that what price swept this high points here with this particular candlestick. Price swept this high point with this particular candlestick. So you can also see that you can possibly have an entry from this single candlestick. Either you take entry also from the 50% of that week, from the 50% of this particular candle's week, because you can see the candle rated this high point, but then price dropped to the downside and then closed below this candle high. So you can see what we have is price fell to the downside. What we have, you can see we have a change in character. Price created this inducement. Price now rated the inducements. So we can switch to a lower time frame to actually look at for how to possibly take an entry from this particular candle, or we can wait to see price create another candle that closes below the low of this candle. But let's also still utilize the week of this candle. So let's switch to the 5-minute time frame since we're dealing with the 1 hour time frame. So you can see that we have our order block resting here. You can see we have our order block resting here. So you can see we have our order block resting here. Did this candle rate this high points? No. So you see we have our order block resting here. So now what you can see is within that week again, we have what? This price reaction here, this week, unmitigated week resting here. And then we have the fair value gap resting here. So we can take our entry at this 50% or take our entry at the order block zone. So let's set our entry at the 50% and also at the order block zone. So you can see this is the order block zone entry. Our stop loss are both here. And then we can also now set at the 50% and then our stop loss slightly above. So let's switch the 1 hour time frame to actually project our take profits area. So from the 1 hour time frame, want to project the profits area to the swing low of the 1 hour time frame. So let's switch to the 5-minute to play price to see what happens. So you can see we have our 2 entries here. So let's play price. So you can see for that particular case, you do not need to actually wait for the creation of inducement in the lower time frame. So you can see price tapped within the 50% of that week. So price have activated this entry. So price is still pushing. Okay. So what you're going to see is that price did not return to the order block. Let's switch to the 1 hour time frame. So you can see that now from the 1 hour time frame, you can see that price created the bearish candle that closed below this candlestick. So in this condition, in the lower time frame, we can wait for the return of price, create the inducements, price return, rate the inducement, and then we have the fall of price to the downside. So let's switch to the 5-minute time frame. Let's keep on playing price to see. So possibly now we are going to look at this order block, because what you can see is we have the sweep of this high points here. So price took out the liquidity here. And you can see that this candlestick closed below this. So from the 5-minute time frame, we have this order block. So we can also now add another entry here. I want to see price come mitigate these and fall, because you can see price gave us a change in the market's character after mitigating this level. So we can add another entry here. So I'm just showing you how to trade from the single candlestick order block, and then also take profits to these low points. So let's switch to the 1 hour time frame to actually play price to see. So let me pull out this other one because price did not activate this entry. So this is now our new trade entry that we are trying to see, considering that price now closed below the candle that swept this high from the 1 hour time frame. And then also you can now see this candle also swept to the side and then fell to the downside. So want to see price return, mitigate this, and then falls further to the downside. So let's see what happens. Don't forget, we're already in the trade based on entry at the 50% of the week. So now we have price pushing up, down, price pushing to the upside. Okay. So price is yet to hit our take profits region. Okay. So price already hit our take profits, but though you can see that price did not return to activate this entry. So let's switch to the lower time frame to see what happened in the lower time frame. So you can see in the lower time frame, what happened is that price returned to mitigate the order flow, the buy move before the sell move that broke this structure point. So that is what price actually returned to mitigate the order flow. Price did not return into the order block. So this is the example on how to actually trade using the single candlestick order block. I'm going to show you guys other example on how to utilize the single candlestick order block to also have high probability trade setup and not to miss out in certain trade entries.